Value Investing Trap 1: Working Capital. Some companies always seem to trade cheap on an earnings basis. There are some typical traps that make companies optically cheap. One of the most important traps to be aware of is poor working capital cycle. In this episode, I will walk you through the working capital cycle of a product company to explain why some companies seem to earn good money but never gets recognition from the market. This is one of the companies that Charlie Munger hates. If a company retains earnings, meaning that they don't pay the earnings out to the shareholders as a dividend, you better follow where the earnings go. You must ensure that that retained dollar creates additional value. So where does your retained earnings typically go? A common place for retained earnings is to working capital. Think about a product company that is selling widgets. If the company wants to grow earnings, it has to reinvest any earned dollar into new inventory. If they sold a widget last quarter, they cannot leave the shelves empty. They must replace the inventory with new inventory. So, if the company sells a widget for $10, it has to buy new inventory for, let's say, $5. They therefore have a gross margin of 50%. So, you made $5 on the transaction. That's great. But we all want a growing company. So, to grow, the company invests the received $10 and buys two widgets as new inventory for 5 plus $5, which is $10. So they now have increased inventory in order to grow for the future. The company delivered a positive earnings result of $5 in terms of gross margin, but you actually don't have access to those earned dollars as a shareholder. These are your dollars. As a shareholder, you have a right to the dollar, but you can't access it. It's an accounting profit that you cannot access. If you want that dollar, then the company will stop growing. Similarly, when a widget is sold, the company has to give away the inventory to the customer, but may not receive cash today. It's very common for the customers to be given credit, perhaps 30 to 60 days, in order to pay for the transaction. This is called receivables and is another form of retained earnings. The company has an accounting profit but don't have any cash. The company had to give up inventory but won't receive money before maybe 2 months. So how does the company get money to buy more inventory in order to grow? They cannot leave the shelves empty. If so, any new customer would be disappointed. That's no way of growing a business. So your company has to finance the new inventory. Perhaps they themselves may buy on credit from their supplier, or they may take out a loan from the bank. This costs money, as the bank wants something in return for their loan. A third option is for your company to have reserved cash on the balance sheet in order to finance growth in working capital. So your company may have cash on the books, but you, as a shareholder, cannot necessarily access the cash. They're needed for working capital management. So many product companies may report accounting profits and seem cheap on paper, but at the end of every year, the company always seems to pay a lousy dividend compared to profits. This is because of the first value investing trap: retained earnings going into working capital. Now the story will become even darker. New inventory may someday go out of favor. Remember, your company sold a widget for 10 and bought two new widgets for 5 plus 5. But now it seems that the widget has lost some demand. You can only sell the widget for $7, not 10. So if you sell both for 7, you still have earned $4 in gross margin. You're still profitable, but remember that all of the gross margin has to finance salespeople, electricity, headquarters, marketing, the list goes on and on. A lot of value in product companies sits in the inventory. But perhaps someday, likely when new management arrives, the company realizes that the economic value of the inventory is lower than book value, and the inventory is written down. In a surprisingly large number of companies, the inventory is not written down until there's new management. This is because it creates accounting losses, and no CEO wants to report that kind of thing. Furthermore, the customer receivables may also be written down in the future. Customers go bankrupt, and your accounting profit may be reversed, and you never received a dollar for your inventory. It goes without saying that companies like the one I have described here has accounting earnings of quite low value. A lot of the profits may not be accessible to the shareholders, but will always be reinvested into working capital. Also, a lot of previous accounting profits may be written down in the future. A lot of bad inventory and customer receivables are hiding on the balance sheets of public companies, but they may not be revealed until there's a new CEO who wants a clean slate. Compare the kind of earnings that has been described in this episode to the sale of a new subscription for a software as a service company. SaaS companies typically has gross margins above 80%. Each sale has very limited increased costs. These companies don't have to carry any inventory. There's no risk in inventory to be written down in the future. Furthermore, software subscriptions are often paid in advance before the company needs to deliver the service. There's no risks in customer receivables. On Yahoo Finance, accounting profits look exactly the same, but do not tell me that the economic value of the earnings are the same. The earnings of the product company is worth a lot less than the additional sale of a software subscription. So don't compare earnings to earnings. You have to look at what kind of earnings we are talking about and how the company may grow its future earnings. Can they grow without retaining capital? If so, that company deserves a higher multiple because that company can pay the shareholders a dividend, grow the earnings next year, and pay an even higher dividend. Accounting earnings are not the same. The dark history about the working capital cycle of a product company goes to show the difficulty of managing such companies. It explains why some companies may seem cheap on an earnings basis, but never seems to get a higher valuation. A company that is trading at 15 times earnings, but grows 10% may be a horrible stock. You need to look at the source of the growth. If it retains all earnings and grows 10%, it's very unlikely to outperform the market. It will likely return 10% per annum. A different company that trades at 20 times earnings but grows just 7% may be a fantastic buy. It has a higher multiple and a lower growth rate. But if the company grows 7% but retains no earnings, you will get a 5% dividend because of the 20 times earnings plus the 7% growth. This will outperform the market with a CAGR of 12%. Capital efficient growth is essential when investing for the long term. Companies at higher PE multiples with slower growth rates may be better buys than low PE stocks with high growth rates. Be aware if someone is pitching a growing stock at a seemingly low multiple. Look carefully where the retained earnings go. A value investor may pitch a stock at low book value or low price to earnings, but you shouldn't have too much faith in the book value or accounting profits of a company. Perhaps there is hidden danger in receivables or inventory. And this is before we have spoken about property, plant, and equipment. In this episode, we have only spoken about working capital management. There's plenty of other value investing traps out there. Please interact with this podcast if additional episodes like this is of interest.